Hey, what's up, stock compounders? Brad here. So on March 14th, Joel Greenblatt did an interview with the Investors Chronicle. I believe they're in the UK. This is a podcast that was put on YouTube. There's no video, it's just audio. But I listened to it on YouTube. Fantastic podcast. There's a bunch of stuff here that I want to share with you guys. Probably the best idea is to go listen to this first. It's 41 minutes long, and then come back to this video to kind of help ingrain the lessons from this interview with Joel Greenblatt. So let's get into it. Joel really opens things up talking about yield. Okay, he says everything is about yield. You put your money in the bank and you get a certain return. When you buy a business, it spins off a certain amount of profits every year. And those profits are relative to what you paid for it. Okay? So, Joel pays a lot of attention to free cash flow yield. Okay? As an investor, that's really what we're looking for. And there's a number of ways that a CEO or a management team can convert those business profits into shareholder value. Okay, they can reinvest those profits back into the business if there's an opportunity to do so with that given business. They can return it more directly to shareholders through share buybacks or dividends. So, part of understanding, part of assessing different investments, different businesses that you're considering investing in is, what are the opportunities to deploy this capital, to deploy these profits, to benefit from these profits as shareholders? And what kind of track record does management have in terms of converting those profits into rewards for shareholders? He talks about, if you're going to buy a house, to rent it, right? If you're going to do real estate investing, when you rent a house, you start by figuring out what the house would cost to buy and how much you could collect in rent, right? It's the same idea. Yield. What do I have to outlay? And then what am I getting back each year? That's yield. And that's how you decide whether the price of the house makes sense, right? It's no different in the realm of investing in the stock market. You've got to understand the value of something to figure out if the price actually makes sense. And Greenblatt says this is a good way to look at the whole world of investing, right? What's the yield? How much cash do I have to outlay up front? And how much cash is coming back to me year after year? What do I pay? What's my yield? How sure am I, right, that this money is coming back? How much is coming back? When is it coming back? These are the questions that guide us in making intelligent investments. He says, if you don't have a good handle on the earnings over the next couple of years, skip that company and find one that you can actually figure out. Okay? Most businesses are just going to be too hard to figure out, to make an intelligent investment in. So that's the whole circle of competence concept. Here, Joel gets into his current strategy, right, of managing money at Gotham. Our strategy is to reweight the portfolio daily towards the cheapest 20% of our investable universe. That's the 1,400 largest public companies in the U.S. It's based on trailing free cash flow, okay, and they define it a certain way. I don't think they share that. That's more proprietary, how they calculate the trailing free cash flow for each company relative to the price we're paying, right? So trailing free cash flow relative to price paid. That's how they define value. When I looked this morning, we were in the 94th percentile towards cheap. Okay. Now, if you look down here, Get Think Tanked with Joel Greenblatt, he did another podcast about 3 months ago. And when he did that one, this cheapest 20% basket that Gotham invests in was in the 92nd percentile towards cheap. Okay. And that was about 3.5 months ago. So it's gone from 92nd percentile towards cheap to 94th percentile towards cheap. It's gotten even cheaper over the last 3 months. This 20% of cheapest companies based on free cash flow yield in the US. So that's pretty interesting. He says there are a lot of companies that we can buy at very good free cash flow yields. What has happened from the 94th percentile in the past, right? So they have data going back about 30 years. And they can see when this cheapest 20% basket was this cheap, what happened over the next couple of years. Plus 63% over the next 2 years for that kind of cheapest 20% basket. 63% over 2 years. So obviously very impressive. Now that's not a prediction, okay? That's based on what has happened before under similar conditions, all right? So keep that in mind. He says it's a pretty good opportunity set for that section of the market, the cheapest 20%. The S&P is in the 27th percentile towards expensive. Okay? So on the opposite end, not as far towards the extreme as these cheapest companies are towards cheap, but it's definitely leaning towards expensive for the S&P 500. The 2-year forward return for the S&P when it's been at around this value is 17%, which is subnormal returns over the last 30 years, okay? About 8.5% per year for the next 2 years is where the S&P is today on a valuation basis. He says our definition of value is cash flow oriented. Okay, it's not based on low price to book, low price to sales. It's really free cash flow yield. Okay, it's based on cash flow. He says, I feel the rubber band has stretched for this section of the market to such a degree that the next 2, 3, 4 years should give it a big advantage. Okay, so Joel is much more excited to own these cheapest 20% of larger U.S. companies on a free cash flow yield basis, a trailing free cash flow yield basis, than he would be owning the S&P 500. Okay, so take that for what it's worth. He says there are issues confronting any company that appears to be cheap. All right, there's a reason it's cheap. The job of an analyst is to really look at that and say, is it too much, right? Is the hair on this thing too much? Or does how cheap it is make it worth kind of taking on the hair, the issues? What people tend to do is say, this obvious problem that someone has right ahead of them, I don't want to buy that stock because they have this problem ahead of them and I want to make money in the next year or two. And I see this problem. People tend to avoid these companies that have the obvious immediate problems because they want to make money now. Okay? That's really the tilt of most investors in the stock market. And Joel Greenblatt, one of the books he wrote was called The Big Secret. And what was the big secret? Patience. Okay? Patience is an edge for investors. And this is part of the reason why, right? People see an immediate problem, they say pass, okay? Regardless of the price, really. So as, intelligent, thougtful investors, you might actually go towards the problems, okay? What companies does the market really dislike right now? What are they throwing out? And go in there and say, okay, yeah, I see the problems. Kind of what Buffett did with American Express, with the salad oil scandal. Everybody was running away from that thing. Buffett decided, well, yeah, there's some uncertainty here, right? We don't really know what's going to happen. But maybe I can put my thinking cap on and make an educated guess about the likely outcome. And from his seat, he thought it was likely that this salad oil scandal, wasn't going to take down American Express. They were going to be able to kind of move through it, get to the other side. And that turned out to be exactly what happened. So it's important that we understand how investors, how much they want to avoid these immediate problems, to the point where it can drive stock prices down so much where you can actually be rewarded handsomely by, being willing to take a deeper look at those problems and figure out, okay, is this really an existential threat to the business, or is it just a problem that's going to pass? Right, so there's a systematic bias to make money now. And you can look at, what is the average hold time for stocks today versus what they were 30 years ago. And they have dramatically reduced, right? And maybe that's just a product of how much information we have. And we can kind of pay attention to the noise, which can kick us out of positions that we own, right? There's just over attention being paid to the holdings in our portfolio. And we're not focusing on really the few things that really matter and ignoring everything else. Joel says, when I was doing special situations investing with a very concentrated portfolio, I really could be very patient because I only owned a few things at a time. I only tried to have a few good ideas a year. Okay, it's kind of the punch card approach. I was always looking for the easy ones, right? The 1 foot hurdle, as Warren Buffett would say. Always turning over a lot of rocks, looking in places that other people aren't, okay? Or looking where other people are running away from, right? Where's the fire? Like today, maybe it's the banking sector. And Joel actually talked a little bit about banks in this podcast. He said, in banks, you don't really know what their loan book looks like. You have hints, but it's a leveraged business. It's kind of like a black box. So, Joel mostly stays away from banks, but once in a while, perhaps, like when you have what's happening now in the markets with banks, all of the fear around banks, this is probably more likely to be a time when Joel would be moving in the direction of banks as opposed to moving away from them. Joel started his fund in 1985. I love this story. 1998 was the first year we lost money. Okay, 13 years after the inception of Gotham. So 1998, Joel was down 5%. Okay, the S&P was up 28%. Try to imagine that, like how that would be psychologically. The next year, in 1999, they were down another 5%. Okay, and the market was up 21%. Crazy. So down 5, another 5. S&P is up 28, then it's up 21. Okay, sure feels like a hole that Joel's probably thinking, how are we going to dig ourselves out of this one? Well, in 2000, the market was down 9 or 10%. Okay, Joel was up 115%. And there's a really important lesson here that I'm going to get to in a moment. He says, we didn't do anything different during those 3 years. Okay, same approach to investing. We got paid in 2000 for the work we did in 1998 and 1999. So, you know, that's the market, right? It's not going to reward you necessarily right away for doing the right thing, right? For understanding what a business is worth and making that bet. Well, the market can be irrational, right? It can be all over the place emotionally in the short term. It can take a couple of years for the market to agree with you. But if you do good valuation work, eventually the market will agree with you. That's what Joel says often. He talks a little bit about the magic formula, kind of what went into that. He says, I still believe very much in the magic formula. Okay, there's always, every couple months I see a video, is the magic formula dead, right? Joel thinks it's just alive and well, right? It's still trucking along. You'll be just fine if you buy the little book that still beats the market. You apply the magic formula approach, set it and forget it. Sounds like that's still working just fine, at least from Joel's perspective. The most important thing for investors is to consistently follow an approach that makes sense. Okay? This is kind of getting back to what I was talking about, 1998, 1999. Not good, right? Dramatically underperforming the S&P. 2000, more than double. Okay? You can't let that dictate your investment approach. The most important thing is to consistently follow an approach, right, that makes sense. Avoid the shiny object syndrome. Monish Pabrai talked about this. He said, in 99, 2000, people were selling Berkshire Hathaway to get into pets.com, right? This is the shiny object syndrome. Tends to turn out very badly. Patience, right? Getting back to patience, the big secret. Find an approach that you believe in, right? That makes sense to you, that's rational. And have the patience to see that approach through. So many investors, they just jump from one shiny object to the next. And it is not a path to wealth, to financial freedom. It's a path to losing a lot of money fairly quickly. He says 99% or maybe 99.9% of investors don't know how to value businesses. If you don't know how to value a business, you can't really make intelligent investments unless you're following something like the magic formula approach that doesn't require you to value individual businesses or just investing in the S&P 500, right? So there are ways to invest without knowing how to value businesses. He says most people can't do it, can't value businesses. It's a hard job. It's hard both analytically and emotionally, right? So it's hard in multiple ways. Okay, last page, guys. Page 4 of 4 here. This is awesome. So Greenblatt lays out in 1 minute, okay, how the stock market works, and it's phenomenal. So he's teaching a 9th grade class how the stock market works. He's talked about this before, but I don't think he's described it exactly this way. So there's a jar of jelly beans, As the ninth graders come into the classroom, they're given a 3x5 index card. And their task is to guess how many jelly beans are in the jar. Okay? So, they do what they have to do to estimate how many jelly beans are in there. They write it down on their index card, hand it in, and Joel, tallies up all these index cards. Now, the average of all the numbers that the students have submitted is 1,771 jelly beans. Okay? The actual number of jelly beans is 1,776 jelly beans. 5 off. Okay? Incredible. Now, the next thing he does, Joel asks each student to tell him how many jelly beans they think are in the jar. Okay? The students don't know how many are in there at this point. With a caveat, they can either tell him what they wrote down, or they can come up with a new number, all right, based on maybe what other people are saying. Now, the average of that number that the student just throws out is 850, all right? Less than half of the average that were submitted when the students were doing their own work, okay, independently thinking, kind of figuring out, okay, how many jelly beans are in this jar. So that 850 number, that's how the stock market works, right? There's all these influences, emotions, right, that influence investors, that are not based on kind of cold, hard, rational calculation. So that is just a phenomenal example. I love that. At the end of that, Joel says, markets are emotional and you have to be cold and calculating. Okay? If you get sucked into the emotion of the markets, how can you expect to do better than the market? He's asked about spinoffs. Okay? He says 40 to 50% of my book, You Can Be a Stock Market Genius, was about spinoffs. Okay, so clearly a very lucrative corner of the stock market for Joel Greenblatt to really be finding these undervalued opportunities in. He gives an example here of why spinoffs can offer such potential. If there was a law that said every time you bought a house in New York, you also had to buy one in Cleveland, and every time you bought a house in Cleveland, you had to buy one in New York, the combined value of those two houses would be at one price, okay? If all of a sudden the law were repealed, and now the highest and best buyer for the house in New York could just go buy that house in New York, and the highest and best buyer for that house in Cleveland could just go buy that house in Cleveland, the combined value of those two houses would go up, right? Kind of makes sense. You're not forced to buy something you don't want. Pabrai has talked about, if you had to buy a painting, a Rembrandt, and you had to buy the Picasso with it. You couldn't just buy the one you wanted. You had to buy a package deal. Clearly, there's going to be value unlocked if you can just buy the one you want, and the other person who wants this other thing can just buy that. So that's how spinoffs can really unlock value for businesses. Number 2, companies don't typically cut their empire in half or get rid of assets that they control. Okay, it's not a normal thing that companies do. They're typically adding to their kingdom, right? They want more assets. When you're separating, you're usually doing something selfless and to help shareholders, right? You're trying to unlock value for shareholders. It's a nice indicator that you think shareholders will come away better off in the long run, right? Once the dust settles. In the short run, when a spinoff happens, there's usually indiscriminate selling, right? You've got institutional investors that own a company, something gets spun off. Well, they didn't buy that company for the thing that's getting spun off. Maybe they can't own that piece that was spun off for whatever reason, right? Maybe they can only own companies that are a certain size, or the nature of their business is such a way. There's indiscriminate selling, okay? You have a new company that hasn't been hyped, right? This isn't like an IPO kind of situation. So Greenblatt thinks it's just a fertile area to look for opportunities. And clearly the data supports this. I'm sure that's why Greenblatt got interested, because he did his research and saw, these spin-offs, there tend to be a lot more mispricings if I'm fishing in that pond versus, other opportunities. So it's still a fertile area for opportunities. I'm sure it's more picked over today than it was in the 80s when Greenblatt was up and running with Gotham Capital, but there's no reason to think there aren't still opportunities in this world of spinoffs. Monish Pabrai has something called a free lunch portfolio, and this is something he picked up from Charlie Munger. Charlie Munger said something like, if you really want to do well as a investor, as a stock picker, as an active investor, focus on 3 areas, okay? Focus on cannibals, companies that are buying back their own stock. Focus on spin-offs, and focus on shameless cloning, right? Really following what great investors are buying and selling. Now, I think it was about a year ago now, Pabrai got rid of that spin-off basket. He changed it into a spawner basket. So, take that for what it's worth. Maybe there's just so much more competition in the realm of spin-offs today than there was back when Greenblatt was operating there. That it's just a lot harder to find opportunities. But it's probably worth looking. Last point here. This is advice from Joel Greenblatt to all of us. If I were teaching somebody about investing, I would tell them, read everything about Warren Buffett that you can, okay? Buffett has been so generous, putting, so much incredible content about value investing for free out to the public. I have a book here, the Letters of Berkshire Hathaway, like 50 years worth of letters. Watch the annual meetings, right? There's so many resources from Buffett that can help us all become better investors. So anyway, guys, that's all I have to say today from this podcast with Joel Greenblatt. Oh man, it's great, especially when you see, 586 views in the first 2 days, right? These podcasts with Greenblatt show up on these really obscure channels, which is kind of fun, right? Because you get to see this stuff before a lot of other people see it, and it just, I don't know, it's fun. That's it, guys. Thanks for watching, and I will see you all in the next one. Take care.